So even though we have robust risk management plans, but within our entire risk tolerance range, if we see a trade going bad, what is it that we can do? So let's take an example. And we set up a triangle here where we are selling a short call at a strike of 10,800 and a short put at a strike of 10,200. And the spot price, let's assume, is right in the middle at 10,500. Now these figures in the bracket here, they represent our running profit and loss. So right now we've just set up this trade, so our profit and loss is zero for this trade. Now we will see that as the option price changes, how does the PNL of each of the leg of this triangle changes, and how we can recover if one of the leg is going bad. So let's say now the spot price is trending upwards. So it's made a move all the way from, beg your pardon, it's made a move all the way up from 10,500 to 10,700. So when the spot price increases, as we learned earlier in option Greeks, the delta of call will become heavier than the delta of put. So since the spot price has moved away from the strike price of the short put, the put delta will reduce and the call delta will increase. So this way, the loss that we'll incur on the call leg of our triangle will be greater than the gain that we'll incur on the put side of our trade. Now, how do we restore this balance? So what we can do is that we can now move up the strike price of the put side of our triangle. So we move the strike price up from 10,200, where we are making a profit of 45 bucks, to 10,500. So we pocket the 45 bucks as profit and sell a new short put at a strike price of 10,500. And this way we restore the delta balance. So now our net PNL in this trade is minus 15, but now we have collected an additional premium on the short side of this trade. And let's say if the spot price moves up still further, since the call delta is becoming stronger and the put delta is becoming weaker, now the PNL on the call leg is minus 80 bucks, and we have gained additional 15 bucks on the put side. But here you will notice that the delta of call will be much stronger than the delta of put, because the strike price of call is very close to the spot price here. So this delta will be far outweighing the short put delta. So we've got to be restoring this balance, because if we do not do that, then even though our trade PNL is currently within our risk tolerance limit, and let's assume that our risk tolerance limit for this trade is net minus 100 bucks per share. So even though we are well within our risk tolerance right now, but from this point onwards, if we do not make any adjustment, then the losses, if the price were to continue going upwards, then the loss on the call side will be much higher than any gain that we make further from here on the put side. So to restore the delta balance here, now what we can do is we can push up the strike price of put even further and bring it to 10,600. And we can roll up the short call strike price as well and make it and push it a little further away from the spot price. So we move our short call strike from 10,800 to 10,900 and put from 10,500 to 10,600. So we have pocketed a total premium of 60 bucks on the put side. We have set up a new short put option here, and we set up a new short call option here. So our net PNL remains minus 20, but now we have rebalanced the delta of our trade, so that now no matter where the price moves, we will not really see a big difference between gain on one side and the loss on the other side. So let's say how this plays out further. So let's say now, for some reason the spot price continues to trend and it goes way past a short call, and it's gone all the way to 10,950. And let's assume that the spot price move happened overnight, which means after the close of yesterday's trading session. So we didn't have an opportunity of stop lossing this trade or rolling it up in time. So now that it's already happened as a gap up, when I come into the trading session today, what is it that we can do? So what we are seeing happening here is that, compared to yesterday, now I'm making an additional loss of 80 bucks on short, whereas my put has gained only by 60 bucks. So my net PNL moves up from, or rather moves down from minus 20 to minus 40. So I'm making a loss of 100, cumulative loss of 160 on the call side, and a total gain of 120 on the put side. So my net PNL is now minus 40 because of the sharp move of spot price upwards. So now the call delta is very high and the put delta is definitely a lot weaker. So what is it that we can do at this point of time to readjust this trade? So this is what we can do. So now we make a drastic change. So all the way from 10,600 as a strike price of a short put, now we move the strike price of our put to beyond the spot price, and we sell a short put option at 11,000 bucks. And by doing so, what we'll end up converting our original strangle into something called an inverted strangle. So an inverted strangle is a strangle where the put strike is greater than the call strike. So now, as you will notice, both these options in this inverted triangle are in the money. The short call is in the money, and so is the short put. And our net PNL is minus 40 bucks, but now it puts us in a very interesting situation, because if the price were to move up further, we are gaining on the short put side, and if the price were to fall, then we are recovering some of our loss, which we are currently incurring on the short side. So it will give us a very nice range of any price shock movement, or it will give us a very nice range of immunity against any price shock movement in a range which can go all the way down here and all the way up here. So this is the way that we can actually recover a trade which is going bad. And sometimes we may not have an opportunity to act in time because of an overnight move. So this is how we can recover. And if the short price and if the spot price were to close anywhere within, let's say, a range above this price, 11,000, and even below 10,900, we will end up making a net profit on this trade and end up recovering the initial losses and eventually close this trade on a winning note, on a profit. So as we saw in this example, option is an excellent instrument in helping us recover from a bad trade and eventually even convert it into a profitable trade. So in the next video, we'll take yet another example of yet another bad trade situation and see how we can recover from it.